Investing in equities is assumed to be one of the most complex forms of investments. In this video, I want us to bring out a basic understanding of what equities are with regard to different forms of enterprises as we pursue an understanding on investing in equities. First, what is equity? Equities are also known as shares, common stocks, ordinary shares, or ownerships. Now that we have identified equities to also be known as shares, that brings an understanding. We all know what shares are. Let's define a share. And a share becomes a registered unit or a unit, a piece of the registered share capital or a limited liability company, or a piece, a unit of the share capital of a limited liability company. Before we look at the company as a form of business, we need to note that there are two types of shares. We have the ordinary shares, and we have another set of shares, we call them preferential shares. Ordinary shares are basically a form of share or units of the capital of a company which are characterized by the fact that they do not guarantee any form of return, and in essence they are the last form of capital to be paid or appropriated a return or a profit of the company. Preferential shares do have a guaranteed percentage. That means their return is fixed irrespective of the amount of profits or returns generated by the company. And they are given preference. That's where we draw the name preferential shares. They are given preference in that their return is paid prior to considering the ordinary shares, to mean that the preferential shares can have a pay of their return or a share of the profit of the company, and the ordinary shares miss out, because at the end of the day it is a portion of the profits of the company that is distributed to ordinary shares, and it depends on the performance of the company and projections of the company. In some cases, instead of the directors distributing to the ordinary shares a profit, the profits can be plowed back for purposes of funding expansion of the business, and the shareholders get an allocation of bonus shares, or in other cases a right issue if the company intends to raise more capital without interfering with the existing control of the company. Control depends on the percentage of shares with respect to the total share capital of the company held by individual shareholder. So that we don't dig deep to that direction, because we are looking at basically an understanding of what share capital is. We have three major forms of businesses. We have sole proprietors, we have partnerships, and we have companies. A sole proprietorship is a business registered, owned, and controlled by one person. And to distinguish it from a company, because we also have forms of companies that are owned and controlled by one person, we distinguish the two by a legal requirement that all companies must enjoy limited liability status, which is not enjoyed by sole proprietorships. Limited liability status means or seeks to protect the owners of the company where in this case, legally, the liabilities of the company shall be borne by the shareholders, the ordinary shareholders, to the extent of their shareholding in the company. Meaning that the liabilities of the company should and cannot spill over to the private investments or private properties of the owners. That is too much be outside the share capital. We want to grasp an understanding of share capital and how to invest in it. With partnerships are owned and controlled by between 2 to a maximum of 20 persons. And partnerships do also enjoy limited liability status depending on their form and registration. Aside from that, companies are legally regarded as persons just like natural persons. So with that respect then, unlike partnerships and sole proprietorships, which do not enjoy a separate entity status from their owners, companies are separate and distinct enterprises from their owners. And therefore, a company can own its own property, operate its own bank account, assume its own liabilities, get sued and sue in its own name, unlike the sole proprietor and partnership. So that means in the event of investing, legally, sole proprietorships, their capital is not a requirement for purposes of registration. And so are partnership. But when it comes to companies, at the point of registration, a company must declare its registered share capital, which is divided into units that we are calling a share or shares. The required or the legal minimum registered capital of a company is 100,000 shillings divided into 1,000 shares of 100 shillings each. That is to say that at the point of registration, by the time the owner or the directors, the shareholders receive a certificate of incorporation for a company, that document, that process will have already given that new company a statutory value of 100,000. Unlike a sole proprietor business and a partnership. At the point of registration, a company acquires a statutory value of 100,000 shillings. So now, a company, because its share capital has been divided, it becomes easy to sell out those pieces or units of share capital and draw money or acquire funding from members of the public. But that is legally limited because only public registered companies are authorized to obtain share capital from the public and through the Nairobi Stock Exchange. Private companies can, and there is a process that a company undergoes before listing. For a company to be able to be enrolled or listed in the stock exchange for purposes of generating capital from the public, that process is called listing. And it also means that if a company ceases to meet the set requirements to remain listed in the bourse, then that company can be delisted from the exchange. The exchange will support two things. And those are the major reasons why we invest in companies. One, we invest in companies or in company shares capital for one, a dividend as a return. And the second reason for investing is growth. So those are the only two reasons why we buy shares. Either we buy shares for growth or for dividend purpose. That said, private companies do also have their own capital requirements, and in that case, they normally generate or source their capital straight from the members of the public, but through private arrangements. I'm sure you have watched or seen or heard The Lion's Den. You have also heard about the Shark Tank. Those are avenues through which startups, private businesses raise capital by selling a stake, a percentage of their share capital to the providers of capital. In the same line, when we go to buy shares for companies through the stock exchange, we are buying stakes. We are buying shares that form a stake, a percentage of the volume of capital or shares of that particular company. In this case, I'm trying to bring or closing the gap and bring out the point that the easiest way to grow wealth is by becoming an entrepreneurship, creating businesses, or investing in businesses through share capital, acquisition of equities. And it is far much riskier, but as we say, there is a trade-off, a direct correlation between risk and return. The higher the risk, the higher the return. For a quick growth or quick creation of wealth is by spotting, analyzing, and investing in startups, because it's easier to get a big stake for a small amount or a relatively affordable amount of capital. It is easier to secure a 20% of the share capital or a stake of a private business or startup as compared to investing 100,000 in established and listed companies in the bars. That said, purchase of shares can only be done in the Nairobi Stock Exchange and in two ways. Just as we had discussed about the capital markets in this video, the capital markets, we highlighted and identified that that is a segment of the financial market that deals with long-term instruments. And one such instrument is a share, company shares. And in this sense is that shares capital form part of the permanent or core capital resources of a company, and therefore share capital cannot be withdrawn. You cannot withdraw share capital from the company that you have invested, but you can sell to another person. That selling of shares happens in the stock exchange, that is the capital market, and it's what we call trading. You can buy the share either through an IPO, that is an initial public offering, like we had the case of Safaricom IPO. Remember, we also had the Kenchen IPO. That is when an investor buys directly from the floating company or the issuing company. That is an initial public offer, and it forms a segment that we described earlier in the capital markets, which we called a primary market, where the parties involved in a primary market will be the floating or the issuing company. We have the market intermediaries, and we have investors. To distinguish that primary market with the secondary market, which is the trading market or trading segment, of the capital market is that in the trading segment, we do not have investors. In the trading segment, we have intermediaries, which commonly we refer to as brokers, where if you are selling your already existing shares, you instruct your market intermediary, that is your broker, and the buyer will also buy through another broker. So mainly we have the companies and the market intermediaries in the secondary market. What is the minimum amount that you can invest or that you can acquire? The minimum sell volume or the minimum transaction volume of shares is 100 units of a specific company that you would want to invest in. For example, if you want to buy Safaricom shares, East Africa Brewery shares, KCB shares, or any other company shares, the minimum required amount, volume, the number of shares that you can buy at once is 100 units. So the total amount that you would require to pay will be composed of two values. It will be the units multiplied by the unit price to get the amount of capital that you're supposed to pay. But the market intermediary, your broker, will charge you a small fee, that is a brokerage fee, which in most cases is 2% of the amount that you are investing. And therefore that gives us the share capital amount and the brokerage fee to form the total amount that you're supposed to pay per purchase. And the price differs from one company to another, but the volume remains the same, 100 units per purchase. Comparing that minimum required amount for investing in the capital markets with the minimums that are required to invest in the bond market. Remember from our earlier discussions, a bond will refer to both a treasury bill, a treasury, bond, and commercial papers. For treasury bills and bonds, which are the common types of bonds that we invest in, the minimum required is 50,000 for bonds and 100,000 for treasury bills, and in cases 50,000 per both, but you can invest to a tune of less than 1,000 in the capital markets. For example, if the unit price of a share of a company is 3 shillings and the minimum required volume to purchase shares is 100 units, it means the share capital, the amount that you pay for that minimum purchase, is the 100 shares multiplied by the 3 shillings per share, which gives you 300 shillings. Then on top of that, we shall add the broker or the brokerage fee, and assume a 2% of the 300 that we are investing. That will give us 6 shillings. So in total, with the 306 shillings, we are able to invest in the stock market. That expression alone, I've decided to use such a small amount of investing to indicate that it's easy. There's no excuse of not investing in the stock market or in the company shares. Look at this scenario. You have a mobile telephone company that you are so loyal to. You are buying airtime every day. You are using their mobile money transfer every day. You are paying so much in transaction fees and that airtime. Why would you not want to share in the profit of that company which you have contributed to build? Now that you learned how to open your Thou CSD accounts, you have started investing in bonds, you should diversify your portfolio by investing a percentage or creating a percentage of your total portfolio to have a stake in the capital market or in equities, and another percentage in bonds and other forms of investing. In this kind of analysis or in that determination, we use your hedge rule or the hedge rule, in which case we use your age to determine the proportion of your portfolio that should be invested in the capital markets or in equities, and the proportion that should be in fixed income securities, or the low risk investment and the high risk investment. Because investing in equities, there is a higher risk, there is a higher chance of losing, as there is a higher chance of getting a high return, as compared to the fixed markets, the fixed return instruments, in which there is a lower chance of losing but a fixed return on those investments. And therefore, whatever is your age, that is the percentage that should be in the fixed income security as your portfolio. And 100 minus your age will be the proportion of your portfolio that should be in equities. So to say, the younger you are, the higher the amounts or the percentage of your portfolio that should be in equities. To put that one into perspective, a well-celebrated billionaire, Mr. Warren Buffett, started investing in equities at the age of 16. We are celebrating him today in his 80s. But he began his journey of investing in equities when he was 16 years old. He hit the billionaire status on his 50th birthday. So generating wealth in equities is a long-term process, is a long-term plan. And therefore, the earlier you take the risk, because the younger you are, the better your chances of recovering any losses from the risk associated with investment in equities. Summary, we have said that there are two reasons why we invest in equities. One is for growth, and the second one is a dividends. We have also said that to purchase equities, you are either doing it in the capital markets. We have 63 registered companies whose shares are traded in the capital markets. You will either purchase the shares through IPOs or trading in the capital markets through a broker. The other way to invest in equities is by identifying and evaluating and analyzing startups or private businesses and acquiring stakes by injecting capital, and through a legal process, a proper process that we shall be outlining later after looking at the investment trading in the capital markets. We will look at the procedure, the legal aspect of ensuring you don't lose your investment when you are investing in private acquisition of equity. If that information has value, kindly give a thumbs up, engage us in the comment section, share this information with another person, and don't forget to subscribe to the channel if you are new. We are committed and deliberate to giving value-based content to enable you or empower you be a DIY investor or a do-it-yourself investor. If this is the kind of content that you would want to be getting, hit the notification button that you'll be prompted by YouTube whenever we upload another value-packed video. Thank you for watching.